It's Colin Hour. I want to welcome you all to the third and final installment in our CanLend Lending in the COVID Era series, where today we're going to focus on, from an investor perspective, on real estate lending and how it's been affected by COVID and how it's performed and what the prospects are for it going forward. We are joined today by my colleague, Dan Williams, who's one of my co-founder of Kilgour Williams Capital and managing partner of our firm, as well as Allen Shayanfekr, who is the co-founder and CEO of Sharestates, major real estate lender in the United States. Without further ado, I will turn it over to my colleague, Dan, to introduce himself and a little bit about our firm.
Great, thanks, Colin. I am Dan Williams. I'm one of the partners here at Kilgour Williams Capital. I'll be the Williams portion. Our firm has been around since 2009. We just had our anniversary of 9 years in our office, and we manage the Kiwi Private Credit Fund. And the Kiwi Private Credit Fund is designed to provide a steady, non-volatile return to our investors. And we do it by investing in small balance loans. So we're big believers in diversification as a way to mitigate risk. And we invest in three verticals: prime consumer loans, small business loans, and short-term residential real estate development loans, which we're going to talk about with Alan today. We launched the fund a little over 3 years ago. We've never had a down month. Every month we pay a positive distribution. The portfolio itself is allocated roughly 40% to consumer, and then 30% to small business, 30% to real estate loans that we fund through Sharestates. For fund performance, and this isn't a pitch or an advertisement for our fund, but rather a conversation about what Alan does. But just because we're here, it shows our consistent fund performance. The fund returns 7 to 8%. It's a stay rich down the middle of the fairway type fund, not get rich fund. And this year, even in spite of COVID, we're still going to get pretty damn close to the 8% target.
Alan, if you could take a couple minutes to introduce us to yourself and also to Sharestates and your business model and how you work with folks like us. Keep in mind, we have folks from both Canada and the United States here today, coast to coast, but primarily Canadian. So assume we don't know a lot about your business, and you're obviously based in New York, so assume we don't know a ton about it.
Sure. Hi, everybody, and thank you for joining us today. My name is Allen Shayanfekr. I'm one of the co-founders and the chief executive officer of Sharestates.com. We are a marketplace lending platform. So we've been in business now for just about 6 years. The company was started by myself and two co-founders who came from a title insurance industry background. When we launched our platform, we initially launched it as a syndication platform that was primarily targeting individual investors and small investors that were buying fractional loans via our online platform. We've grown since then over the last 6 years to originate about $2.5 billion loan volume. That's been across 30 plus states, where we've delivered historically between 8 and 12% net returns to investors year over year. We've also grown into a pretty large institutional investor base, working with some of the country's largest institutional partners, including asset managers, investment banks, hedge funds, private equity groups, pretty much all different institutional investors that you could imagine, with the exception of endowments and insurance companies, although we have worked with some insurance companies directly as well. And then on the other side of our business, we have our borrower network, where we're essentially financing speculators and developers with two core products. We've got a short-term 12 to 24-month bridge product that's designed for residential asset classes, essentially providing borrowers with liquidity and financing to go in and create some value. So that could be a fix and flip project. It could be a gut renovation of a multifamily asset, or even ground up construction. And then we also, towards the end of 2018, launched a 30-year term product as well that was essentially designed as a takeout. So we would take a borrower through the value-add development phase of their project. Once they've completed that project and leased it up, we're now providing a 30-year term takeout for that as well. Investors like Kiwi, for example, would participate via our crowdfunding platform or syndication platform and the bridge asset. And then we would actually refinance that loan internally as well for a 30-year product. We are essentially a financial technology company, so we've built a ton of technology to help augment and facilitate our business. Pretty much at this point, we've created an end-to-end solution, which has helped us scale our business to pre-COVID. We were closing just ballpark about $100 million per month with relatively limited staff, which enabled us to build a profitable business, giving investors like Kiwi and many of the others that we deal with some confidence in the platform and that we're here for the long term. And despite all of that, we've still managed to be pretty close to break even during COVID as well. We are back to originating now, though, as of August, and I'm happy to share more details with that as we